Hey, good morning, options traders, and happy Wednesday. It's hump day. So, what is the restriction principle? Well, I thought this might be helpful for the group. And the restriction principle is used a lot in finance and economics. And it's similar to when you've heard me talk about benefits. So, I might say that a certain strategy has a benefit over another one. And if there's a benefit, you have to pay more for it. Well, the restriction principle is that same idea, just looking at it from the opposite side of the fence. You're saying if we have a restriction applied to a strategy or a pricing principle, it must be worth less. So why bother with this? Well, sometimes it's a lot easier to see things in terms of restrictions than benefits. And so they can be very beneficial for helping traders understand option pricing principles without getting into complex math or arbitrage strategies. Just apply the restriction principle. And they can help you to understand strategies and all kinds of things by just understanding this one simple concept. So, what is the restriction principle? Let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, the restriction principle, what's this all about? Well, it's really just a method of thinking, and it helps to understand option pricing relationships and strategies. And it rests on a very simple foundation that less cannot be worth more. So let's start with a fairly simple example that I think you'll know intuitively, but it will help you to see the restriction principle. So here's the question: which is worth more? So on one hand, we have the August $100 call, and on the other, we have the August 100-105 vertical spread. Now, again, most of you will understand this intuitively, but that's why I'm starting with this example. So, how could we apply the restriction principle? Well, this is how we would do it. I'm going to consider two strategies. Strategy A is the $100 call. Strategy B is also the $100 call, but we're going to attach a restriction to it. And for strategy B, we're going to say, all right, you can own the $100 call, but there's a restriction that you can only profit up to $105. And when we describe strategy B that way, that's the same thing as the 100-105 vertical. So remember, when you own the 100-105 vertical, you have the right to pay 100, that's the long call, and you've got the obligation to sell for 105, that's the short call. Well, that's the same thing as saying that you can only profit up to $105. We've used the $100 call in this vertical, but we've restricted it. And when you apply a restriction, it can't be worth more than the one that we're comparing it to. So now we immediately know that the $100 call must be worth more than the 100-105 vertical. And again, normally when this is done, especially in finance books, they show it with complex arbitrage pricing relationships. But just by understanding the restriction principle, you can immediately see the answer. And if we look at the risk graphs, it becomes even clearer. So in black is our $100 call. Remember, we always get a bend at the strike, so there's our 100 strike. And in red, we have the 100-105 vertical. We get bends at 100 and 105. And you can see that the red line sits higher than the black, which is to say that it's cheaper. In this example, it looks like the $100 call is trading for about 5. That would be the maximum loss. But the vertical spread has a maximum loss of 2. So it's not worth as much. And that's because we have sold off all of the rights above 105. So it's the same thing as the $100 call with an attached restriction, and so we know it can't be worth as much. Now, in this case, you could also look at it in terms of benefits. If you have the $100 call in the vertical spread, which it is part of, but if you didn't sell the 105, you would have the benefit of unlimited gains out this way. So this is an easy one where we could apply the restriction principle or look at it in terms of benefits. Is it better to have limited profits or unlimited? Well, all things equal, we'd rather have unlimited gains, and so there's a benefit in the $100 call over the 100-105 vertical, so we could therefore say the $100 call must be worth more money than the 100-105 vertical. But again, the restriction principle is used because sometimes it will be a lot easier to see things in terms of restrictions instead of benefits. So let's go try another one. Which is worth more? Let's say we have shares of stock and we're going to compare it to the May $100 call. So how could we look at these as being the same with an attached restriction? Well, let's say that strategy A is shares of stock and strategy B is also shares of stock, at least almost. We're going to attach a restriction to this. And we're going to say that for strategy B, it's kind of a specialized share of stock here, we're going to require that you pay more for it, and you can only control this stock for a limited time. Well, that's obviously not as good as just owning the stock. So if we have stock with an attached restriction, it has to be worth less. But what is this? What is a share of stock with these conditions on it? That's the same thing as a $100 call. Now you might say, well, why do you pay more with a $100 call? Remember, options have an extrinsic value to them. So if this $100 call is trading for 3, and you pay 3, and you exercise it, got to pay the 100 strike, you've paid a total of 103, even though the stock, let's say, is trading for 100. You will always pay a little bit more, unless it's trading at parity, but you'll always pay a little bit more for the call option. So that's where that's coming from, but we also know that it has an expiration date, so it's going to be for a limited time. So again, if you had some type of a weird share of stock out there that says, okay, it's the same thing as regular shares, but you have to pay a little bit more for it, and you can only control for a limited time, you'd say, well, that's not as good. That's a restriction, and we know that it can't be worth as much. So now we know that the $100 call is worth less than stock, or conversely, stock has to be worth more than the $100 call. Now, I've talked about this in other videos when we've talked about pricing relationships, and I said that call options must always trade for less money than the stock. Even if you had a zero strike call, which doesn't exist, but that would trade for still less than the stock. If you had a zero strike call with unlimited time to expiration, that would trade for exactly the stock's price. Well, there is no such thing as a zero strike call or an option with unlimited time to expiration, so we know for sure that every single call option, no matter what the underlying stock is, no matter the volatility or the time to expiration, it absolutely must be worth less than the underlying stock. And that can be a really good insight into understanding strategies, pricing relationships, and how these strategies will unfold over time, just by understanding the restriction principle. So let's try another one here. Which is worth more? Let's say that we have an American-style May $100 call, and we're going to compare it to a European-style May $100 call. So remember, quick background here, there are two styles of options, American style and European style. An American style can be exercised at any time for any reason. A European style can only be exercised at expiration. Now, whenever you're dealing with equity options, such as on Microsoft, Nvidia, Amazon, those are always going to be American style. However, a lot of indexes are European style, and in some cases they might even have both. So we might see the S&P 100, the OEX. If you trade OEX options, they are American style. But you can also trade the XEO style, that's just having the letters reversed, and they are now European style. So the question is, which should be worth more? Well, let's apply the restriction principle. Let's say that strategy A is an American style $100 call for a given expiration, and strategy B is that same call, but we're just going to attach a restriction to it. And the restriction is you're not allowed to exercise early. And so we know that strategy B is really just a European style $100 call in disguise. And because of that, we can quickly deduce that the American style call must be greater than the European style call. Now that doesn't mean it's worth a whole lot more. In fact, if the stock doesn't pay any dividends over the life of the option, the American style and the European style will trade for the same price. But we do know that the European style call could never trade for more money than the American style. Why? The restriction principle makes it crystal clear. So, when considering complex decisions or strategies, think about the restriction principle, and many answers become clear. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.